Hello, folks. Brian Calley here, CEO of the Small Business Association of Michigan. And, I want to share with you an example that I worked up to illustrate an important point that is relevant to a proposal that is being considered by the Board of Canvassers and will likely shortly be out for petition signature collection. And the concept here behind this very bad, very problematic, very harmful to small business idea is to create a new graduated income tax. And the message behind it is that we should tax the rich in order to fund education. Of course, us at SBAM, the Small Business Association of Michigan, are very, very supportive of education, are very active in both outcomes and accountability and funding for education. So this shouldn't be viewed as against the concept of appropriate and adequate funding for education. But this idea that Michigan should essentially overrule its own constitution that prohibits graduated income taxes, implement a new graduated income tax in this state at a rate that would make us among the most expensive in the country on the top line rates would be it'd be foolhardy. It's short-sighted and would be quite harmful. But here's the key that I want to express to you is two main things. First is most of those who would pay this new tax are small business owners. They're not independently wealthy people. I mean, some of them might be wealthy, but I'm going to share with you, number two, the second point is how on a business owner's tax return, it can show a lot of income, but it doesn't mean the business owner is actually getting cash. It doesn't mean the business owner is actually getting that income. Taxable income and what the owner gets are two completely different things. And they're completely different things for a lot of reasons. And so what I've worked through an example, and this is a very kind of contemporary example. It was on my mind because of an issue that was recently temporarily dealt with in a change in federal law. So it has to do with how expenses are recognized. So I'm going to demonstrate in this example to you, and I'm just going to share my screen. This is a hypothetical example, but the sort of issue that's not particularly uncommon. And this is a small business example of how the the um, the cash flow and the taxable income are very different things. And this is how a tax return, the Michigan tax return and the federal tax return will show like a bunch of income. And yet, what's the reality in terms of actual income, cash income to the owner? Radically, radically different things in many, many circumstances. So, what I've decided to do in this example is to highlight a situation where how amortization, required amortization under federal law of certain expenses can play out when it comes to taxable income versus cash flow of the owner. In this case, my example would be a software development company. So this would be like a company that is developing custom software for customers. And that type of work, a lot of the work that is done by the software engineers is actually development or research and development. It falls in that type of category. And federal law goes back and forth. Sometimes you can expense that, sometimes you have to amortize it over longer periods of time. And so here's my hypothetical example. I've oversimplified this because if I tried to use actual tax forms, it would be um, your eyes would cross, and unless you're a tax accountant, it wouldn't mean a lot to you. But here's just a breakdown in a hypothetical example, but using actual rates and how this stuff plays out in the real world. So on the left-hand side over here, we've got cash flow of the business. So I want you to imagine a software engineering company, maybe they got 10, 15, 20 employees, something like that, and they've got $1 million contract and they need to invent a software solution for a particular problem. So the income that they get is $1 million. It's $1 million contract. Sounds like a lot, right? $1 million. But when you consider that this software engineering company would have um, several, perhaps dozens of employees, you can see how $1 million would go pretty quickly toward employment costs. So in that type of business, a lot of the work that they do, and sometimes it's all of the payroll that goes into making the software, is classified as research and development. In other words, They're developing something new. They're inventing something new. And technically that something new could be used on other projects in the future. And so the federal government says, yeah, you're making something now and you got expenses, but that expenses will have future benefits. So what the federal government does sometimes is they say, well, that type of expense, you can't just recognize the whole expense this year. You got to spread that over time. And in research and development, for the last few years, the way that the rules have worked is it said, no, you got to straight line amortize that over 5 years. And so what's happening for the business on this left-hand side is they've got $1 million in income and they've got $850,000 in actual payroll expenses. They are expensing this money and that money is out the door. Okay, it's a real cash outflow to the business. But let's look at what's happening on the other side here on the taxable income calculation. On the taxable income calculation, the federal rules up until this year, they're actually going to change this year, but just giving it just as a contemporary example on something we've been working on, is that the federal government says, no, if it's research and development expenses, including payroll, you can't expense it. You can't take it off your taxes. You have to spread that over 5 years. So in other words, you take this $850,000 and you say, no, what's $850,000 divided by five? That's what you can reduce your taxable income by. So that's 170. In this example, it's $170,000. So what's the net taxable income here? 180,000 or $830,000. Like that's so much money, right? That's not what the income of the owner actually is. That's just the tax calculation. The actual reality for the owner is over here. They really expended all 850,000 this year. And so they have only $150,000 in gross income. Now, that's not the end of expenses for businesses. I was just to use a round number that's probably conservative. In other words, actual outcomes would usually exceed what I'm sharing here in terms of expenses. But I just doing a 10% overhead cost. You got to have accountants. You got to have human resources, you got to pay the electric bill, you have rent, you have all these things. It's probably more than 10%, but in my example, I just included 10% here. So actual cash outlay for overhead expenses, $100,000 in this example. Okay, so what's the net profit margin to the owner? $50,000. But let's look over here and because you can't deduct, they don't let you deduct the whole 850,000. You only can deduct the 170,000. You have to spread the rest of it over the next 4 tax years after this tax year. And then that same overhead, okay, so that's deductible. Most of that's going to be deductible. So what's the taxable income? $730,000. This is the reality. Look at the difference between this. This isn't some pie in the sky type of an example. I could have used a lot of different aspects of the tax code to show how this situation could have played out. The fact that the federal government fixed this R&D issue for a few years for us, it has it on my mind. So I use this as an example. But in this case, you've got net profit and actual like cash available for the owner at 50,000 and taxable income is 730,000. So a lot of people would look at the tax return of the business owner saying, my God, look how rich you are. They're not that rich, right? That cash was expended. It was given to the employees already. It's just the federal government doesn't let you take it off your taxable income. But here's the problem. Here's the thing. It gets way, way worse than that because your taxes are based on that taxable income. And so here's what happens. Federal taxes, if you have taxable income at this level, you're going to be paying a rate of 37%. Now it's graduated. I'm just taking this project out, right? I'm looking at this as one of the $1 million kind of increments in the overall business. It's probably not the only project that this business had going that year, but this is how cash flow works out in this situation. We've got federal taxes, 37%. That's $270,000. Okay, and then state income taxes, even if this bad idea to increase the individual income tax rate to 9.25 for small business owners like this, even before that, you can see that the total tax liability comes to more than $300,000 for this business owner. And so people will look at the tax return information and say, "Oh, big deal! You still got $428,000 left." The business owner still has that much money, and it's so much to live on. What's anybody complaining about? But let's go back over to the real world, the actual cash position of the business. This is the place where I think that people truly need to understand. If you care about small businesses, if you support small businesses, if you think that they add value to the economy, if you want them to survive and to be here so that it's not just all ginormous mega corporations, but you actually have small businesses operating, this is a really important point to make. This is the reality. This example, by the way, it comes from one of our members that shared with me their situation. I didn't get their actual tax return, but walked me through what literally has happened to them recently with respect to the way that taxable income and cash flow do not match up. So net profit margin on this $1 million software development contract, net profit margin $50,000 that would be like the owner's take, if you will. But that's not what they get because they've got to pay $270,000 in taxes. Remember, they pay taxes based on this taxable income over here, the 730,000. So they have to expend all of this money in taxes. That's not amortized over 5 years. They have to pay that right now. They have to pay that for this tax year. And then they have to pay the state income tax. So for this business owner in this particular year, even though their taxable income shows 730,000, the net cash position of the business was negative 250,000. That is the reality that our small business owners regularly face. And if they're growing small businesses, it compounds these problems. Ironically, if they stay the same, some of these things over time can kind of catch up and they're not as hard to deal with because, yeah, I can't expense everything now, but I can expense some of the things from previous years this year. If the business isn't growing, ironically, these things don't hurt them as much. If the business is growing, these things can kill them. That's why growing businesses are so fragile. They're the most exciting and the most important and and have the highest projects for job growth. And yet they're the ones that are most at risk when bad ideas like this happen. And so here's my ask to you on this. This is one simple example, all right, of how taxable income and actual cash to the owner can be not just different, but radically different. And if somebody comes to you over the course of the next few months or through the fall or even through the winter and says, "Hey, would you sign this petition? It's going to increase education funding and it's only going to affect only rich people will have to pay more." I want you to know from actual IRS data that 77%, it's actually more than this, but we know at least 77% of the people that will be subject to this graduated income tax proposal to fund education are small business owners. It's not people are imagining, oh, it's just going to be billionaires and they should have to pay their fair share, is how they put it in this proposal. That is not the majority of the people who will be affected by this proposal. Most of them are small business owners. So please, please, if you are asked to sign a petition like this, I want to ask you to decline to sign. You don't have to be rude about it or anything, but just say, no, thank you. I support small businesses. I'm not going to sign that document. Thank you for your time and attention. Please do share this information, this insight with other people. Probably there's not too many of them that are probably gonna watch a video this long and get this far into the weeds. But here's a really important stat for that you can just share real simply with people is that it's not rich people that are going to be paying this tax for the most part. 3 out of 4 of them are small business owners. If you support small business owners, please decline to sign.